Something is happening inside the COMEX vault system right now that is generating questions from some of the most informed and experienced silver market participants in the world. Not casual observers, not retail traders scrolling through social media. Serious, professional, institutional level market participants are looking at the May delivery picture, looking at what is sitting in COMEX vaults and asking questions that do not have comfortable answers yet. And when professionals start asking uncomfortable questions about silver supply at the same time that May deliveries are approaching, that combination of timing and circumstance is something every silver investor needs to understand deeply before it becomes front-page financial news. That is exactly what we are going to do right now. Let me start by explaining why May specifically matters in the COMEX silver delivery calendar, because the timing of this story is not coincidental, and understanding the delivery cycle is the foundation of everything else we are going to discuss. COMEX silver futures trade in specific contract months, and May is one of the active delivery months in the silver calendar. As a delivery month approaches, and specifically as First Notice Day draws closer, the dynamics inside the COMEX vault system shift in ways that are genuinely revealing about the true state of physical silver supply. First Notice Day is the date on which holders of long futures contracts can first be required to take delivery of physical silver against their position. It is the moment when the paper futures market and the physical silver market have to actually reconcile. Before First Notice Day, a long can hold their futures position purely as a paper trade with no intention of ever seeing a silver bar. After First Notice Day, that position becomes a potential claim on real, physical, vault-stored metal, and the days and weeks leading up to that reconciliation point are exactly when the COMEX inventory data becomes most informative and most actionable. What the current COMEX vault data is showing as May deliveries approach is a picture that raises legitimate supply questions on multiple levels simultaneously. Registered silver inventories, the metal formally certified and designated for delivery, have been under sustained pressure. The trend has not been a single dramatic drop that grabs headlines. It has been something potentially more significant, a persistent, consistent directional drainage that reflects ongoing physical demand from the system rather than a one-time event. Persistent trends in COMEX inventory data are harder to dismiss than single-session spikes. A one-day drop in registered silver could be an accounting artifact, a single large holder reorganizing their vault position, or any number of technically benign explanations. But a multi-week trend of declining registered stocks moving into an active delivery month, that is a pattern that demands serious analytical attention rather than convenient rationalization. To understand why this matters so much, you need to understand the arithmetic of the situation clearly and completely. At any given time, the total notional silver represented by open COMEX futures contracts is many multiples of the registered silver sitting in COMEX vaults. This is not unique to silver, it is how futures markets function across commodities. The system operates on the assumption that the vast majority of futures contracts will be settled financially rather than through physical delivery. Most longs will roll their positions to the next contract month rather than stand for delivery. Most shorts will do the same. The physical delivery mechanism exists to anchor the futures price to the real physical market, but it does not need to be exercised by every participant for every contract to perform that function effectively. The system works until it doesn't, and the conditions under which it stops working smoothly are exactly the conditions that COMEX vault data and delivery statistics allow informed investors to monitor in advance. When registered inventories fall relative to open interest, the ratio of paper claims to available physical metal rises. When that ratio rises into an active delivery month like May, the probability of delivery stress, not a certainty, but a genuine probability, increases in ways that are measurable and visible in the data well before any actual market disruption occurs. If this level of structural analysis is what you have been looking for in your silver market research, please hit that like button and subscribe to this channel right now, because this is the depth we bring every single week, and we want you here for every video. Now let's talk about who is actually standing for delivery in May, because this is where the story gets specifically interesting and where the professional community's questions are most pointed. The identity of entities taking physical delivery from COMEX is not always fully transparent in real time. The exchange reports delivery statistics, but not always the identity of every party. However, the patterns of delivery behavior over time reveal things that anonymous reporting cannot fully conceal. When delivery demand in an active month is being driven primarily by commercial users, industrial silver consumers who need physical metal to run their manufacturing operations, it suggests the physical supply pipeline outside the COMEX system is tighter than normal, forcing industrial buyers to source metal directly from exchange vaults rather than from their usual supply channels. That is a meaningful signal about real-world physical silver availability when delivery demand appears to be driven by financial entities, investment funds, trading houses, entities whose normal business does not require physical silver for industrial consumption. It raises additional questions about motivation. Are they taking delivery because they believe physical silver is undervalued relative to paper? Are they concerned about the integrity of the paper-to-physical relationship? Are they positioning ahead of anticipated price moves that they expect to be large enough to justify the cost and complexity of holding physical metal? The questions themselves are informative regardless of the specific answers. The eligible to registered conversion dynamic is another layer of the May delivery story that deserves careful examination before we talk about what it all means for price. As we have discussed in previous videos, eligible silver metal in COMEX approved vaults that meets exchange quality standards but has not been designated for Delivery represents a theoretical reserve supply for the registered category. When registered silver is drawn down going into a delivery month, the natural market response should be for vault owners to convert some of their eligible holdings to registered status, replenishing the delivery supply and easing the physical pressure. Whether that conversion is happening at a pace sufficient to offset the drainage of registered stocks is one of the most important questions to ask right now. If conversion flows are robust, if eligible silver is smoothly transitioning to registered status as registered declines, it suggests the system has reserve capacity and the tightness in registered stocks is manageable. If conversion flows are sluggish or insufficient, if eligible silver owners are reluctant to designate their metal for delivery despite the pressure on registered stocks, that reluctance is itself a significant signal. It tells you that entities holding eligible silver do not currently want to make it available for delivery at current prices or under current market conditions. That kind of deliberate withholding of supply in the face of delivery demand is not a neutral market signal. It is a statement about price expectations and physical market conditions that has historically tended to precede meaningful upward price adjustments. Let's discuss the role of the major vault operators in this story, because understanding who holds silver in COMEX vaults and how they behave is essential context for interpreting the inventory data correctly. COMEX-approved silver vaults are operated by major financial institutions and specialized vault operators entities like J.P. Morgan, CBC, Brinks, and Malka Amit, among others. The distribution of silver holdings across these vaults is published in the daily COMEX inventory reports, and shifts in that distribution carry information. When silver moves between vaults from one operator's facility to another, it can reflect changes in ownership, changes in custodial arrangements, or repositioning ahead of delivery. When silver leaves the COMEX vault system entirely showing up as a net withdrawal from all approved facilities simultaneously, it tells you that metal is moving out of the exchange ecosystem entirely. They're to industrial consumers, to overseas buyers, or to private holders who are choosing to store their metal outside the COMEX system. Net outflows from the COMEX vault system as a whole, sustained over multiple sessions heading into a delivery month, are one of the most direct physical supply signals available. They are the market voting with actual metal about where physical silver is most valued and most urgently needed. Now I want to address something that sophisticated silver market observers have been increasingly focused on: the relationship between COMEX silver dynamics and the London OTC silver market, specifically the LBMA system. COMEX and London are connected markets. Silver can and does move between the two systems in response to pricing differentials and physical availability. When COMEX registered silver is under pressure and lease rates in London are simultaneously rising, it suggests the tightness is not purely a COMEX artifact but reflects a genuinely global reduction in available above-ground physical silver supply. That cross-market confirmation is significantly more concerning from a supply perspective than COMEX tightness alone. When both major trading hubs are simultaneously signaling physical supply stress heading into an active delivery month, the market is providing convergent evidence from multiple independent sources, and convergent evidence from independent sources is exactly what distinguishes a genuine supply signal from statistical noise. Let's talk about what happens historically when these supply questions remain unresolved as a delivery month arrives, because history is the most useful guide we have for understanding what may could look like if current trends continue. The COMEX silver market has experienced delivery stress events before, moments when the paper to physical ratio reached levels that forced rapid and disorderly price adjustments as shorts scrambled to cover positions. The most famous example is the Hunt brothers episode of 1980, which ended badly for the Hunts but demonstrated the explosive price potential when physical supply cannot match delivery obligations. More recently, the March 2020 period saw significant strains in precious metals supply chains that caused dramatic temporary dislocations between paper and physical prices, and the early 2021 Reddit-driven silver squeeze, while ultimately not sustained, demonstrated the sensitivity of the silver market to sudden surges in physical delivery demand when registered inventories are not abundant. None of these historical episodes are perfect analogs for the current situation. Every market moment is unique in its specific configuration, but the structural similarities: lean registered inventories, elevated open interest, approaching delivery obligations, and professional participants asking pointed questions about supply are present in the current picture in ways that make historical precedents genuinely relevant rather than merely illustrative. Here is the price implication framework that serious silver investors should be working with right now, given everything the COMEX vault data and May delivery picture is revealing. In the near term, meaning the days immediately surrounding first notice day and the peak of the May delivery period, the supply questions currently circulating among professionals have the potential to create price volatility that is disproportionate to normal daily silver price ranges. The mechanism is straightforward. If delivery demand runs higher than the market has priced in, shorts who cannot source physical silver at current prices must buy back their positions. Buying pressure from forced short covering in a market where registered supply is already lean creates price spikes that can be rapid and significant. The size of those potential spikes is in part a function of the paper to physical ratio. The higher the ratio, the more potential energy for a sharp move when the equilibrium breaks. This is not a prediction that a squeeze will occur in May. It is an honest assessment that the conditions present in the current COMEX data give a delivery-driven price spike a higher probability than it would have if registered inventories were abundant and the paper to physical ratio were at comfortable levels, assigning accurate probabilities to market events. Rather than either dismissing risks or catastrophizing them is the discipline that separates investors who make money from those who react emotionally. In the medium term, across the weeks and months beyond the May delivery period, the supply questions being raised by the current COMEX data are part of a larger structural story about silver's physical availability. Mine supply is not growing. Industrial demand from the solar, EV, and semiconductor sectors is growing rapidly. Investment demand is increasing as more investors discover the monetary properties of silver in the current inflationary environment, and the COMEX vault system, which functions as one of the primary mechanisms through which the global silver market balances supply and demand, is showing signs of stress that reflect those structural forces in real time. The May delivery questions are not the whole story. They are a current, visible, time-sensitive manifestation of a story that has been building for years and will continue to unfold for years more. Investors who use the May delivery dynamics as a window into the larger structural supply picture rather than treating it as a self-contained short-term event will understand the silver market more completely than those who see only the near-term delivery calendar. Let me give you the specific things to watch in the COMEX data over the coming days as May deliveries proceed, because actionable monitoring is the practical purpose of everything we have discussed. Watch daily registered silver inventory levels and note whether the trend of drainage continues, stabilizes, or reverses. Watch canceled warrant numbers each morning for any spike that indicates accelerating physical delivery demand. Watch the conversion rate of eligible to registered silver. Is the theoretical reserve supply actually flowing into the delivery-ready category or not? Watch the daily delivery statistics as first notice day passes and actual deliveries are reported. The total number of contracts standing for delivery in May relative to registered inventories will tell you immediately how tight the physical situation actually is. Watch the silver basis. Any move toward backwardation as delivery approaches is a red flag of the highest order, and watch lease rates in the London market for cross-market confirmation of physical tightness. These are not abstract academic exercises. They are the specific, concrete, real-time data points that tell you whether the supply questions professionals are asking right now are being answered reassuringly by the market or are intensifying towards something more significant. Leave a comment right now and tell us, are you watching the May delivery data closely, or is this the first time you are hearing about the supply questions developing in the COMEX vault picture? Your responses genuinely shape what we cover next, because this community's level of sophistication grows every week and we want to make sure the content meets you where you are. And if you know a silver investor, someone holding physical silver, silver ETFs, or silver mining stocks who has not been tracking the COMEX vault dynamics heading into May deliveries, share this video with them immediately. The information in this video could genuinely change how they think about their position sizing and their timeline over the coming weeks. We will see you in the next one.